but I was born in South Carolina.
Hmm.
Grew up and was raised in South Carolina and got my business start there. I'm a graduate of Clemson University in South Carolina. And when I got out of college, I really didn't know what I wanted to do. So to be able to pay bills and make some money, I went to work in our family business. And little did I know that that was going to end up setting the stage for the rest of my career. But it was, it's fairly early in the being involved in the family business that I got access to the company's financial statements, and I looked at the financial statement. I didn't have a business degree; I had a zoology degree, so all this stuff is pretty foreign to me. But at the same time, it's basic math. You got revenue and you got expenses and you got a bottom line, and it just didn't seem common sense to me that the
Hmm.
bottom line was so small relative to the top line.
Yeah.
So, of course, really ingratiated myself with my family when I posed the question about why in the hell aren't we making more money? And of course, here's the young kid out of college who they are perceiving thinks he knows it all. But in all seriousness, I mean, that did set the stage. I didn't know it at the time for me being involved in companies that were underperforming or that had made serious mistakes but were not troubled. And
Hmm.
so, kind of long story short, with the family business, it took that my first hostile deal was with the family. It was a battle for 6 years. And finally, after 6 years, I was able to buy control of the company. I took the family business, put it up under a holding company, and used it as a capital base to do acquisitions of smaller, complacent, underperforming companies. And the key right there is the complacent aspect of it. Because my
Hmm.
first wave of doing acquisitions were focused on smaller companies. They hadn't really made mistakes, but they were performing pretty far below their potential. They did need management changes, but they were complacent. Strategic mistakes hadn't been made. You had owners that had been in place for too long and probably should have gotten out 10 years prior to that. So that was kind of the first wave of the transactions I did, and I completed that in the last company I bought was in 1986. By 88, I had sold all of it and
Okay.
took a little bit of time off. And when I went back into the financial world, the the focus was a bit different. Now it was on, in fact, I actually started with a couple of really seriously troubled companies. I knew
Okay.
that wasn't the focus, but that was the of the second phase of my business career. That was the kind of the launch pad that morphed into companies that had made some kind of either strategic or managerial mistake, meaning they had appointed the wrong CEO and the
Yeah.
CEO had taken the company into a downward spiral or something. And no rocket science here, but just where it was clear that there was an underperforming aspect of the company and that it had made at least one mistake. And it's a part of the investment thesis is you
Are
fix the mistake.
these, sorry, are these privately held companies or publicly held companies at this
Both,
point?
both.
Okay. Wow. Okay. So you've approached this with a pretty significant. Sorry, we should probably confirm what was the industry that your family business was in that you scaled and
The
sold.
family business was it was an operating company. It wasn't a holding company initially. It was an operating company, but it was in multiple businesses.
Oh, okay.
It was in ice manufacturing, refrigerated warehousing, petroleum distribution, motor oil distribution, and within petroleum, you had several different sectors. There was home heating oil, which was the biggest part of the business, of the
Yeah.
overall business, and commercial gasoline and commercial diesel fuel. So that
And
was
so, did you after you'd sold and you took a bit of time? Did you look for businesses within those verticals, or were you looking for any kind of business at that point?
I was looking for any kind of business, but the best ones that I found were ice manufacturing companies. They would typically fit the bill in addition to the underperformance aspect and later on with mistakes. They also fit the bill from the standpoint of the stability, predictable cash flows, and even with the mistakes that had been made because of the dominant market shares, there was a solid business underlying the mistakes. Um, big moats around most of them because of the dominant position. So they and simple businesses from the standpoint of understanding it, very difficult businesses to run.
Hmm.
I'm certainly not capable of running any of them. I had to get people better than myself to do that.
So
So
that's
that
a
ended up
good.
being it wasn't a sole focus, but it became a big focus.
That's probably a good place to sort of pause and think about when you talk about, you don't feel like you're capable to operate them. How did you find the right people to do that? Because presumably I mean, we should probably talk about some financials if we can, but we're sort of like talking about scaling quite aggressively because of all the acquisitions. So you're going from a standing start of $0 a year in revenue to like, how much are we talking within kind of a 1 year, 2 year, 5 year period?
I should differentiate phase one of my business career with phase two. Phase
Hmm.
one was building a diversified company via
Hmm.
acquisition.
Yeah.
Phase two was not. Phase two was one deal, get it done, get out somehow. And
Okay.
there was the intent to have a big focus. Now, I
Hmm.
think the most I had going on at one time during that whole period, which lasted from the early 90s up through 2017, I think the most that I had going on at one time was two companies.
Okay.
And these were also keep in mind, these were not behemoth companies, but they were, as I moved forward in that phase, they were much larger companies than the companies that I had been involved in the first phase.
Hmm.
And
Hmm.
they also required a lot of attention and a lot of work. And so I was not really building a company as much as the real focus was on doing really, really good deals and creating value as much as I could create after
Yeah.
the fact. It was not the focus on building my company.
Hmm. Hmm.
That makes
And
sense.
so, yeah, yeah, it does. Yeah, yeah, absolutely. So these two companies, you obviously, the thing that you mentioned about the start was why are we turning over so much and profiting so little? How did you find these companies and how did you know they were in trouble? And then how did you subsequently turn them around?
Um, this is going to sound like a non-answer, but the
Okay.
companies in that second phase, the companies they there was no magic to it. They came to me.
Right.
And I say they came to me. I stumbled upon them. Somebody knew somebody else who referred this or whatever. There was no search that was going on. The first phase, I had an aggressive search, developed a buyer's package and the whole 9 yards. And it was fairly sophisticated.
Hmm.
This one, it started with somebody calling me up and saying, my company's in trouble. Can you help? And that led to one thing to the next. And I really didn't have any formal process there. But again, keep in mind, I'm not focused on building a company. I'm focused on doing deals. So
Hmm. Hmm.
I can also turn down a lot. It worked out. It was a strange phenomenon, but it somewhat snowballed on itself.
So what piqued your interest then? If you get in, it sounds like you weren't struggling for deal flow at that time. So if someone approached you and said my company's struggling, what about that situation made you think actually there's something here for me to kind of get my teeth into and roll with?
No, I had to take a look at the company. I mean, I'm a financial guy, so I always start with the numbers.
Hmm.
And with this particular company, it was starting with the numbers and delving very deeply into that, and then realizing real clearly that as much as I liked the person who called me, that he and his partner were not real bright, and they had done some things that were just really really stupid with that company, and the company was at one point it was on the Inc. 500 fastest growing companies, and they got in over their head. The growth was so fast and they didn't have control over the expenses. It's real basic stuff. This stuff is not rocket science. You know, Carl
Hmm.
Icahn's tried to make that same point with what he's done. It looks like maybe from the outside that it's complex, and it's really not. It's fairly simple in this case. You had two guys who were bad managers and they let the costs go out of control to the point that they were doing some things that they literally shouldn't have been doing as far as withholding from 401k contributions. So,
Oh
but
wow.
what I
Yeah.
did in that particular situation, I went in and it just remove them, put them back into lower positions in the company, and cut the costs pretty drastically, and sold the business.
And how? if someone approached you and said, "Can you help us?" and then you've sort of gone to them and said, "Yes, but I need to demote you significantly." How did that work? Did they keep some shares in the sort of skin in the
Oh yeah,
game, or did
yeah. I
you?
mean, yeah.
Right.
They kept their ownership. In this particular situation. I didn't buy the company.
Hmm.
I did not even invest in it. The first two deals that I did in this first phase, they were more. Although I got control. I mean, that was part of the thing. I had to have control,
Yeah.
and I might as well have bought the company from that standpoint. But legally, they still own the company. And in
So
this
you were a
case,
consultant then,
I got them
essentially.
out of trouble.
Nice. Okay. You were a consultant then, essentially. You
Yeah,
came in
but
as kind of a third party.
it was more than that. I became chairman of both of the first two companies. I became chairman of the company, and I made sure that I had full authority to do what needed to be done. Otherwise, every time I turn around, I'd have to ask for permission from people who had already messed the company up. So
Yeah, for sure. So is that a similar story with both of those companies, the two companies you spoke about from the early 90s to
yeah,
2017 then?
the first two, and then beyond that, the situation changed where it was either buying the company or investing in the company. Then there was one where I was able to, through a pretty big battle, take over the board, which if you in this particular situation, taking over the board, putting new board members in, you might as well have bought the company. Yeah, for all practical purposes.
Wow. Can we talk about that? Can you discuss that?
Sure. It was a company that actually I was already on the board of the company. I knew the people who owned it, and the company was it was a merger of this was not a roll up company. This was and I'm gonna differentiate roll up with industry consolidation. This
Yeah.
was a company where the industry had several really big players. There weren't any small players. It just had several big players. And at some point in the latter 90s, consolidation started. So with this particular company, it was the merger of two companies and the acquisition of a third. So
Hmm.
now you got a much bigger company than any one of the single companies. Secondly, you've got a company with three different cultures, and
Yeah.
cultures are pretty different. And
Hmm.
you ended up with the CEO was the owner of one of the companies that merged. The COO and CFO came from another one. The one that was acquired didn't provide any management. And it was kind of like that company I described earlier. Shortly after all this was put together, you started with the financials, started seeing the downward spiral. Not much is happening with revenue, and expenses are getting out of control. Then they put an ERP program in place, and that it was supposed to be $2 million, and it still hadn't been completely implemented at 6 million. So it was a whole
Wow.
a whole series of things. And I took kind of an activist-like approach with it. I'm on the board, I'm the only outside board member, and
Yeah.
I started pointing out the things that were going wrong. I mean, I could spend a lot of detail, but long story short, at some point it got bad enough. And it's just like, anybody, if they want to fix it, if an alcoholic doesn't fix their situation until things get bad enough, in this particular situation, these guys weren't willing to make a change until it got bad enough. And at some point it got bad enough. So the end result was I became chairman. I had carte blanche to restructure the board, brought in competent board members, left the owners on the board, but
Yeah.
they were removed from management. And by this point, the company's struggling. So the first thing we did is we brought in a turnaround guy,
Yeah.
a consulting firm, and the lead consultant became the interim CEO. He
Hmm.
stayed in place for a year. Then we brought in a permanent CEO, and in that particular situation, I've been fortunate to bring in a lot of good CEOs. This guy was the best I've ever worked with. And that company went from the worst with all of its key metrics, the worst in its industry, to by the time it was sold, it was the best. And we were able to track that because KPMG did studies of that particular industry as the animal health distribution industry,
Yeah.
ethical drugs for small animals.
Yeah.
And KPMG tracked the metrics in that industry. So we were able to do the comparatives. And I mean, the credit goes to the CEO and his new management team. But it was the same playbook that I was using elsewhere. And it's, again, it's not rocket science. You figure out what's wrong with it. And in this particular case, what was the key that was wrong with
The
it is
leaders.
these managers were just they were in over their head,
Hmm.
and they couldn't manage the company. It needed more sophisticated management. So they got replaced. The board got replaced. It was a governance arbitrage and a management arbitrage play. And we were fortunate that the CEO we found was excellent. I mean, I'd like to put him in every company I'm involved in.
Is he still going? Can you
I
are you
don't know.
still in
He
touch with
he
him?
and I'm 72. He's the same, roughly the same age I am. I don't know if he's still functioning or not. I have. It's been a while since I talked to him.
Amazing. So so you've I mean you're talking about pretty significant bodies of work, and you've kind of summed it up in a few minutes, and there's loads of kind of threads that we can pull on there. But where did you how did you sort of get from being an outside board? So presumably you were non-exec board member at the start, were you? And then you've managed to get to chairman. So how does that role work? Do you need to get approval from the rest of the board? Do you buy shares enough to sort of buy more votes?
In,
How
in
does
this,
that transition work?
well, if it had been a public company, yeah, it'd probably been the route of buying the shares. In this particular case, with it being a private company, you had the ownership was made up of the owners of the three companies that combined.
So these are
The
the guys
third
that
one was
weren't
acquired,
performing
so
well.
that there was no ownership involvement there, but the two that had merged. And
Hmm.
I mean, bottom line was it had to get bad enough, and I just gave them an ultimatum. I said one of two things is going to happen. I said either you're going under, and your entire net worth, everything that you got, because they like so many business owners, everything's wrapped up in the company. I
Yeah.
said you're going under, or you're going to let me do what I've been asking you to do for over a year, and that's step into the chairmanship and be given reasonable carte blanche to get this thing fixed. And
Hmm.
they finally said, okay.
How bad did it, like, where was it before in terms of like numbers, if you can share sort of turnover or whatever? How bad did it get? And then where did you manage to get it to
But
before you exit?
I don't like to talk about numbers of companies I've been involved in, especially private ones.
Ah, yeah, okay,
I can
okay.
give you percentages to me, and this maybe it may help it.
Hmm.
I'll give you a couple of things. One, the value of the company at a consistent EBITDA valuation multiple. The value of the company by the time that I stepped in the chairmanship had decreased by 90% from the time of when the merger and the acquisition first took place. It
Wow.
had declined by 90%. So you had debt that had increased. You had EBITDA. EBITDA had actually gone negative at this point. So
Wow.
you've got pretty severe performance and value, obviously value
Hmm.
deterioration. And it was a lot more shaky than I would like to be involved in, but that was just the nature of the beast on that particular one.
Hmm.
And we went 12 months with that when we had the turnaround guy in there as an interim CEO. We had board meetings every month, and every month we had a lawyer at the courthouse waiting to get the instructions to file Chapter 11 because we weren't
Oh,
sure it
wow.
was that shaky for the first year. And then some sprigs of daylight started showing up. The turnaround guy did a pretty good job.
Yeah.
There was a point where his skills couldn't take the company into the future, and we had to find a different type of CEO.
Hmm. What's your sort of vision in terms of you've got on the board, you've managed to get into the CEO role. Are you looking for an exit, or are you just looking to improve things and for it to sort of improve your cash flow? Or is there always like an end in mind with these things that you're
Yeah,
doing, these acquisitions you're
the end
taking?
is in this second phase of stuff. The end has always been an exit
Yeah.
of some type, and in the same way in this one, the end play was an exit. Early on, there wasn't a whole lot of focus on an exit. The focus on survival. But once
Yeah,
we got
yeah, yeah.
past survival, then yeah, and we operated we had a 5-year value maximization plan that was developed. We
Hmm.
had some 4 or 5 key initiatives, and the function of the board, we've tracked those initiatives like a hawk, the progress towards them, and the CEO obviously helped develop the value maximization plan, but the board was
Hmm.
involved, and he did a yeoman's job in executing it. And
Yeah.
not again, it's not rocket science. It's might be rocket science if it's a tech company, but I don't know enough about tech. I can barely turn the damn computer on, so
I
Uh,
think
I
I,
like to stay with things that are simple and basic and have certain characteristics.
I think the interesting thing is I know you don't want to share, but we're talking about company. We're not talking about companies with 10 or 50 employees. It sounds like we're talking about significant companies, and the roller coaster, the extreme highs and the extreme lows when you're dealing with companies at that scale. I mean, you mentioned the three companies coming together and there being like a total culture shock. Like, how do you even approach resolving that? Because it's all very good and well kind of getting the people in the top, and I guess a lot of it funnels down from there. But
Yeah,
to the guy,
that's a great question, and I've got what I hope is going to be a good answer, and then
okay,
a really as a part of that, a really great one.
okay,
It's one of the greatest stories that I've got out of my business experience.
okay, great.
What happened was we did not take when we put the new board in place before we brought in the turnaround guy. We had the whole new board in place. We didn't, and we knew that there were culture issues, but we didn't set out with any kind of intent or plan to change those cultures. What we did was, and we knew not much would be able to be done until we got beyond, until we could be sure the company could survive. And once we got to that point, the new CEOs on board, what changed the cultures were the performance standards that we set at the board level.
Hmm.
Well, that sets the standards for the CEO, and the CEO is pretty much like that himself anyway. And so you've got things that are trickling now from the board level to the CEO level to the new management level, senior team that reports to him. Now it's going on down to the people in the company.
Yeah,
And every time you do something like that, there's going to be a group, and some of them had already gone. The turnaround guy had already terminated quite a number of people. But in this particular situation, there was not a whole lot of fat left to cut. And you just had the people who couldn't function within the higher performance environment, they left.
yeah.
Here's the thing that was neat about this. We're into this thing in year four, and I get a letter from the VP of sales and marketing, and she's writing to me and the board. She sent the letter to me, but it's to me and the board. And in the letter, and I just paraphrase what she wrote, she says something to the effect of, we, meaning the management and employees, would like to thank the board for bringing in the current CEO. She said he's the toughest SOB that any of us have ever had to work for, but yet we are performing and the company is performing at a level that it's never, and she'd been around for a while, that it's
Hmm.
never seen in the past. And she said, and most importantly, she said, we are happier than we've ever been.
Wow.
And I use that story a lot because I do a lot with, I mean, I wrote a book about uh, public company boards and how crappy they are and whatever. And I get accosted a lot by people who are not real wild about capitalism, about taking a hard line on all this stuff. And I always tell that story because it makes the point. People don't get it. Really good people thrive in high
Yeah,
performance environments. And as
yeah.
long as you don't have a dictatorial CEO, it was one thing to be tough, but good people, and we had a lot of good people in that company that thrived. And I've seen that in company after company after company. There'll be a weeding out, but then you'll see the really good ones, the ones who are willing to be accountable. You'll see them rise to the top, and you'll see them thrive as opposed to what they were how they were before.
And I guess it's a rising tide lifts all ships, doesn't it?
Yeah,
If you've got really high performing people in there, the other people who don't want to do as much are likely to leave, which
exactly,
I've seen in
exactly.
my own businesses,
Yeah,
but
yeah,
it attracts the better talent, doesn't it then?
absolutely.
Amazing. Okay, so I mean, we kind of want to talk a bit more about the M&A side. So let's go into sort of theoreticals and your experience with M&A. And you sent me an email earlier today about with a statistic of over 70% of roll-ups fail. What do you think makes the difference between a company that does roll-ups really well and one that does it but fails?
Okay. Yeah,
What's
and
the science?
there's some real clear delineations, but bear with me because there are a few of them. And
Okay.
my contention, I've never done a roll up from start, but what I've seen is a lot of the companies that I've taken over or been involved in some manner, that were underperforming or had made strategic mistakes were roll-up companies. So I
Hmm.
get to see the mistakes that were made. And again, you flip the mistakes into their opposite, and pretty soon it's real clear what's involved in really making them work. So the first thing, and this is not typically of the businesses I've been involved in, but for people who are interested, might be interested, they're listening, they're interested in doing roll-ups. The first thing is picking the right industry. And a lot of people do not trying to do these things, don't pick the right industry. It should
Okay.
be, and this is a real important part of it. It's common knowledge that with roll-ups that the industry should be fragmented. But it needs to be fragmented enough. There needs to be a big enough universe of targets that you're going to be able to get transactions done because everybody's not going to sell.
Hmm.
And a lot of people will never sell. And if you've got a smaller universe and if there's any competition at all, you may struggle getting off the ground. And if you get off the ground, you may struggle through no fault of your own other than picking a bad industry. So it's
Hmm.
important that the industry is uh, that it's fragmented enough. Secondly, it needs to have simple products and or services. Anything that's, you don't want roll up people don't need to be doing unless they really know the business. They don't need to be doing high tech stuff. They need things that are simple. Recurring revenue is important where you don't
Yeah.
have to have a sales force making a sale for every piece of revenue you bring in. Um, Low customer concentration. That's another critical one. And I know in the diligence that we do, early on diligence with ones I've been involved in, that's one of the first questions we have. We want the seller to provide us a list of the top 10 customers. They don't have to tell us who the customers are. We just want to see the percentage of the overall revenue. So
And what's like a red flag to you, and what's a green flag? If are we at like 15% is too much, or 10%?
to me, I mean, I don't know if there's any hard firm rule, but anything over 10% to me is bothersome.
It's
And
too
I'd
much.
prefer it not to even have that. I prefer to see, your larger companies being in the 3%, 2% or whatever, where you've got enough of a
Right.
spread because, you got a 10% or 15% customer. And if that customer is a very profitable customer, the question is if you lose the customer, can you cut cost enough to make up for the loss? It's doubtful that that would be the case.
Mm,
So it's far better to have, I mean, the less concentration.
yeah,
I
of
would
course.
prefer, yeah, 10% is going to be max. And in some cases, depending on what the situation is, that may even be too high. That's my personal perspective on it.
Okay,
Um,
interesting.
Another thing is critical is that this didn't have to, I say it's critical. This is helpful. Is if the beginning of the roll up is accompanied by some kind of outside catalyst. And I'll give you an example. We talked earlier, I've been involved quite a bit in the ice industry.
Hmm.
And one of the companies that I was involved in several different frameworks, including eventually buying it, was a product of a roll up. And uh, one of the things that made even though the industry was just marginal as far as the number of companies, it goes back to this whole fragmented thing. One of the things that was real positive was at the time that companies started being rolled up in the ice industry, the main customer base of the ice industry was also consolidating. So, and as they consolidated and you had bigger companies like Walmart taking more and more of the grocery business, it was important to them to have it as much as they could across a geography, one supplier.
Yeah,
And so you had a timing that worked really well, the consolidation of your big and same thing happened in the convenience store. Convenience stores were consolidating. So your two biggest customer segments were consolidating. That made it make sense for the ice industry to consolidate because now you're able to provide something that the little guys is the bigger you get, the more you're able to provide something that the little guys can't do.
hmm.
So
Yeah,
that's just an example. So all of those things are essential from the industry standpoint. Second thing, and this was absolutely critical, and this is where a lot of roll-ups make a mistake. You need to have the right value creation thesis, and it needs to be twofold. One part of it needs to be the acquisition part of it, where that's a core competency. You're
yeah.
doing the acquisitions and you're able to to get an arbitrage just from the multiple that you pay versus the multiple that you exit at.
Yeah.
That's one half of the strategy is the multiple arbitrage and doing the acquisition part of it well. The other part of it, and this is where so many of the companies that have done roll-ups have failed, is they thought that it was all about just doing deals, putting them together, and you didn't have to do much with the companies after the fact. The other part of it is having a really focused playbook on what you're going to do with the companies to improve EBITDA after you buy them. So you've got two sources of value creation. You've got this multiple arbitrage, and
Hmm.
then you've got the improvement in the EBITDA that you underwrote. So you've got two different things coming together for you to be able to have value at exit. The problem is if you don't do the second part of it, is you will typically, since things don't do real well standing still, they will deteriorate. And I've seen that in more than one situation where a company's doing acquisition after acquisition after acquisition. And what the investing public doesn't realize until the acquisitions stop is the fact that so many of the ones that are being bought are declining after they're bought because there's no attention being placed on them to improve them. So that's critical that that thesis is in place. The third part, and a lot of people aren't going. There are going to be some people who are not going to like this part of it, but from my perspective, it's a fact, and that's capital. And the big emphasis there is on equity capital.
Hmm.
There's been and I don't know if you're aware of this or not, but there's been a kind of a groundswell in people who teach entrepreneurs how
Yeah.
to do roll-ups, and they can start without cash, and they can do
Yeah.
this, and they can do. And I'm
Start
not
with a
saying I'm not
dollar or
saying
start with a pound.
yeah, I'm not saying it's impossible. You can do it. I mean, if you find the right company and somebody else, the seller will finance it. It's not a way to do a roll up, though. It might be a way to try to do a one-off deal. But to do a roll up, you, to do roll ups, you've got to, at some point, you've got to accelerate and be doing quite a number of deals. But you also have to get it off the ground and you have to have credibility with sellers. If
Hmm.
you're always wondering, because you have no equity capital, if you're always wondering whether you can get a deal closed or not, and I've seen three or four of these that people ask me to be involved in them, and I wouldn't do it because of the fact they had no equity capital, and I wasn't going to put it in there because I didn't think they were qualified to do it in the first place. And they're not off the one of them 4 or 5 years ago, and they still hadn't done their first deal. So the equity capital is absolutely essential.
Yeah.
The debt capital is also essential, and my contention is that not only do you need to have at least some equity capital raised before you start, you need to have a real good idea about who you're going to be able to turn to for the debt portion of the financing. In other words, you need to lay the foundation with lenders, whether it's private credit or it's standard banks or asset-based lenders or whatever. And it probably makes sense to talk to all of them to lay
Hmm.
out your plan, make the lender familiar with who you are and where you're going so that when you do go to get the financing, you know what their lending parameters are. They know who you are. You have a clear understanding of what they need to see to be able to evaluate the transaction quickly. So part of what I'm saying here is people starting from scratch to do a roll up. My advice is lay the foundation first before you try to do the first deal. And that foundation, there's a lot of pieces of that foundation. One being sure you have the right value creation thesis, but the other is and already you having some kind of idea what that post acquisition playbook is going to look like, but
Hmm.
also the capital, having that the foundation laid there so you're not scrambling while you're trying to do your first transaction or first couple of transactions.
To
You
find
already
it.
have that foundation there.
Yeah, fine. Uh, Going back to this value creation thesis, because I think people will get a lot of value from that, is
Sure.
what number one, what does a good deal look like for you in terms of the purchase? Like how do you identify whether or not a deal is going to work for you or not?
Well, if it's a roll up, uh, it's going to work because I like the industry. It's going to work unless the seller wants too much for it, or unless there's just something fundamentally wrong with a company where you find out they've committed fraud and there's going to be They won't sell anything but the stock, and so you're going to have the liability that may follow you or whatever, that kind of thing. But I mean, in the experience that I've had, which is not exclusively but mostly with roll-ups, has been in the ice industry.
Yeah.
If if the company is in existence, then it's you can buy it right. It's worth doing. That's the nature of the
So
business.
essentially, it comes down to the price you pay, and that's kind of
Yeah,
it.
yeah.
As long
I
as
mean,
they're not breaking the law,
yeah,
you're getting the
yeah. I
right
mean,
price.
it
It's as
comes in
simple as that.
it because you've already depicted the industry.
Hmm. That's interesting.
Maybe there are situations in other industries where some companies may not be as viable. But I would think in those particular industries, certain parameters would be set. Say, for the example, we're not going to roll up anything below X number of million in revenue or
Yeah.
something like that. But you would already have your target company criteria, so it just simply falls outside of that criteria. But in the ice industry, we in everything that I've been involved in, regional consolidations or nationwide kind of consolidations, pretty
Hmm.
much everything is fair game. Smaller companies or platforms going into a brand new market uh, with the platform and then consolidating around the platform. If I gave one example where something didn't make sense, it might be a company that's for sale in a market that you're not already in, and it's not the platform company, it's a little tiny company. You don't want to buy it. You want to buy the platform company, then come back and buy the smaller one
Right.
because you're going into a market without the strength that you need to have. So, Andy, let me do a couple of things before we move forward. There were two more
Hmm.
things I wanted to add regarding the roll up process that need to be in place.
Yeah.
One is a detailed acquisition process. And by that, I mean from the time that a target company is identified until the post-acquisition value maximization plan is put into place, there needs to be a detailed step-by-step, almost color by the numbers. This is how we do it. Because if you don't have that in place, you end up with chaos. If things fall through the cracks. You have to have a way to track. And the other thing is, you always want to be in a roll up. You always want to be functioning with a sense of urgency. And
Hmm.
this helps you function with a sense of urgency without allowing slop to get into the business. And it's a way for everybody to be on the same page as to where things are. And one of the ways we corrected some of the mistakes that had been made at one of the big companies that I was involved in taking over, that was a roll-up play, was with the acquisition process. They didn't have one prior to that. That fixed a lot of things, including ensuring that the acquisitions, post acquisitions, were accretive as opposed to dilutive. So it's a critical piece of that. The final thing I wanted to add is you got to have the right law firm. And by the right
Yeah.
law firm, it's not
Yeah.
just their legal capability and their familiarity with M&A. It's also their willingness to also operate with a sense of urgency. I don't know how many times I've had transactions trying to get a number of different companies acquired simultaneously, and the lawyers hold it up, and it can cause you to lose the transactions. Anytime you lose momentum, you're
Hmm.
putting an acquisition in jeopardy, and even more so with roll-ups where you may have once you get momentum going and you're really scaling the operation, you're going to have multiple acquisitions going at one time. And so the right law firm that can understand we've got to get purchase agreements done fast, we've got to get employment agreements done, everything. And the more it's boilerplate, at least initially, where
Yeah.
they have almost like your acquisition process, and the only thing they have to do is to make minor tweaks, uh, that's exceedingly helpful.
Can we park on the acquisition process? How do you build a good acquisition process? Because I don't think this is talked about enough. So in your mind, what does that look like, and how do you decide what kind of framework you need the acquisition to look like?
God, that's without providing an
Condense
acquisition
condense
process.
decades of experience into 2.5 minutes, please.
Yeah, it's you got to be sure that I mean, think about your first step is identifying the company. So what you're looking at is you're looking at the steps that are involved in the process. And in a particular situation, you identify the company, then there's got to be contact with the company. Then, depending on how that contact goes, does it lead to a meeting or whatever? And once you get past where the seller says, "Okay, I'd like to pursue a sale," then there are certain things that, at least that I've had, that go into place,
Hmm.
and all during that part up to getting an agreement and a letter of intent. There are a whole different series of steps there. Then once the letter of intent is executed, then you've got diligence moving down one path, and you got two different kinds of diligence going on. You got diligence where you're looking for opportunities, and you got diligence where you're looking for the risk.
Hmm.
So you got all of that going on. You got the purchase agreement being drafted. There's a whole series of things there that have, and you also should have during that period the beginnings of the post-acquisition performance improvement plan being developed, because as the diligence is being done, you may see that in the production operation, they simply have too many people. They haven't structured it in such a way where you can get your cost to the level that you know the cost can be. So all that kind of thing is going on. If you do it right, it's got a lot of different little tiny moving parts. And if you
Hmm.
miss, the more of the moving parts you miss, the worse the performance is going to end up being. And the more chance you got for the deal either falling apart or you making mistakes or not doing well with it after the fact. And third, the other part of it is the more you risk having everybody who's involved getting way too stressed, way
Yeah.
too overwhelmed. And again, this is once it's rolling. Why all the I mean, my contention is when I first started buying, I wasn't doing roll-ups. When I first started buying companies using our family business as a capital base, I put everything in place before I ever approached the first company. I had the lenders lined up. I didn't need the equity because the family business provided the it provided not only the equity capital, it also provided some additional ability to borrow because it was sitting on a lot of very valuable fixed assets that were
Hmm.
unencumbered. But I made sure I had the debt financing lined up. There were a lot of banks I talked to that just wouldn't touch it. But I got some banks that were really excited about it. That was all in place first. The acquisition process, which was more general than specific, like it would be for the roll-ups, all of that was in place. It's just like
Yeah.
private equity firms. Private equity firms have all this stuff in place. That's one of the reasons why they're so good at it, because they're so laser focused on, and things don't fall through the cracks. And I'm referring to the top firms, not all of them. But
Hmm. Nice. Okay, so I think it's worth talking about that because a lot of people just see acquisitions sometimes as kind of a one-off, and there's no like thought about how they're going to go about it before they go about it. Certainly not
yeah,
to the degree that you're talking about. But if you're going to do a roll-up strategy, then you have to go. It sounds like you have to go all in on it because otherwise you're just kind of dipping your toe in, and you're not making the most out of the opportunity.
yeah. I mean, you're
And
not really doing a roll-up. A roll-up is what it says. You need to get the scale with the roll up. If for no other reason, you need to get the scale because you get to a certain point and then your valuation multiple is going to increase without you
yeah.
having to do anything. Just the sheer size is going to bring,
Hmm.
if you're doing well with it, the sheer size, everything else being equal, the sheer size will bring a higher multiple. But that's the way, if you want to maximize value, and that's my mindset going into anything with a roll up, then you need to build it fairly substantially before you exit whatever that exit may be.
Yeah. And it comes back to what you were saying earlier about, basically, essentially, as long as the business has got a pulse and hasn't done anything illegal, then they're a target for you. So the real value creation, then, based on those two things you spoke about, is the next bit that I want to talk about, which is improving the kind of EBITDA, like the post-acquisition work. And so, where do you think this must be when most people make the mistake, other than maybe paying too much money for the business in the first place, but not integrating it well into their holdco or into the part of the larger company. So can you speak on that for a bit?
Let me do one thing first. I want to separate integration from post-acquisition performance improvement. For a lot of people, integration might include that, but for others, and the way we looked at it with the with things I've been involved in, we separated. Integration was the basics, bringing them in on systems. and payroll and insurance and
Hmm.
other HR kinds of things, all the things that would put them on the whole financial system that would put them on our platforms. All of that was considered integration, and we had people who were really, really good at doing that. Then there's the post-acquisition performance improvement, and that was not up to the kind of staff people that did the integration. This is the operating guys. In the case of the big ice acquisition that was faltering and was a roll up, and we continued rolling stuff up after buying it. Uh, that was the purview of the division VP, and then his or her direct report as a regional manager. It's usually the regions that are buying the acquisitions. It's their responsibility, not staff, not accounting, to develop the post-acquisition performance improvement plan. I don't buy into this crap that so many people do where accounting does budgets. Operating people should do budgets. They're the ones accountable for them.
Hmm.
How am
Hmm.
I going to hold somebody accountable if they didn't do it?
Yeah, that's really interesting. So you've kind of got a back office element that will integrate the kind of day to day, if you like, the kind of
Yeah,
admin side of it, and then you've got the operational team that should then sort of take that and run with it.
absolutely.
Yeah.
And with the roll up, you get to the point, at least you hope you get to the point where you've got the process that you lay on top of it, pretty much every company to improve it. It's going to be there'll be certain nuances, but there'll be, for the most part, it'll be the same thing that you're looking at. How are they doing here? How are they doing here? How can we improve this relative to what we know can be done? I mean, part of the idea of a roll up is that the management of the roll up company should be better business people, should be better managers, should be better value creators than the people who are doing the selling. Because if that's not the case, then
Yeah, of
you've
course.
got the
Yeah.
wrong people doing the roll up.
I
That's
think
a,
that
that's a
we
big part of the roll up thing is it's a play of sophistication versus a lack of sophistication if it's done well.
and so it goes beyond just synergies of, we're taking over a company and they've got two finance people, for example, in the back office. We've got a finance team here. We can lose their salaries. You're talking about something that is much more significant than just a couple of cost savings here and there.
That's correct. Although the cost savings you described is a perfect example of some of the type of things where you can improve the bottom line. The
Yeah.
problem is that's easy stuff. That's, people who are not real good operators can figure that kind of stuff out. The other part of it is if you're delivering the product, how are we going to make this routing more, how are we going to reduce their cost per ton delivered to where we think our cost per ton delivered can be. That may be, you may have to be completely restructuring a route system. Same
Hmm.
thing with production. And I'm referencing the ice industry
Yeah,
there
yeah,
because
yeah, yeah.
I know the metrics so well. In production, if their cost per ton produced is X, but our average cost per ton is some fraction of X, we want to be able to bring theirs as much in line with what our best in class is to the degree possible. It won't be possible. Power rates, for example, are different. Electricity rates are different in different markets. But to the degree you can do it, and there's always improvement. I'm not saying one yet where there's not pretty material improvement that can be made. But you called it right. It's not just that low hanging fruit of the synergy part of it. It's actually making the operations better.
Hmm.
That's the tough part. And that's the part where people typically aren't very good at it.
Yeah. I'm conscious of time here, but my last question then really is based on something sort of outside the M&A, but you yourself have said earlier that you're not a great operator, but obviously you're talking about businesses with large scale. So can you share with people, like, how do you find the right people and make sure that they're doing a good job and holding them to account? How have you dealt with the people aspect? What
I, I
lessons
don't
have
I
you
don't think
learned?
there's any magic to finding them. Some have been found through search firms. Some have been found by word of mouth. That CEO I referenced earlier that was just stellar with the animal health merger
Yeah.
company. One of the new board members that was in place after we took over the board, he knew somebody who knew this guy. and this guy had just finished doing a deal with private equity, and he was the CEO of that firm, and he was looking for something to do. It was one of those kind of out of nowhere things. So there's no
Mhm.
rule of thumb. Again, some of it's been by standard search firms. It just depends. But
Right.
what we try to do, here's one of the keys, if especially with the CEO, because that's typically the part of the investment thesis is going to be replacing the CEO. I mean,
Yeah.
I hadn't done one yet where that wasn't the case. That's just part of the ability to create value is you've got a weak CEO in place. The key to that is taking where you see the value creation potential of the company, the things that are going to drive that company forward, and being able to take CEO candidates and look at their backgrounds and their track records and be sure that it aligns with those value creation initiatives. Very few hire people putting CEO boards, putting CEOs in place, take that approach.
Mhm.
It's amazing how crappy, including in public companies, that CEO selection is. But that's a critical piece. But no magic as far as where to find them. It's been word of mouth and formal searches.
Yeah, and just making sure that you've talked a lot about different aspects of this thing, but the common sort of theme here is that you're starting with the end in mind. So you're finding people, but they need to align with the longer term vision. And the same with the framework. Before you do anything, you want to make sure that you've thought about what your end goal is. So it's
You're pretty astute because everything that I've ever done, and I learned this a long time ago, I've always started with the end result in mind, then backed up in the
Mhm.
present and figured out how to get there and what needed to
Yeah.
be, what kind of foundation needed to be laid. It's a method of operating. It's being results oriented rather than process oriented. The process should serve the result rather than the result maybe or maybe not happening because of a process.
Yeah.
A couple of things we didn't get to that were in your initial list. I was looking forward to telling the audience about what an idiot I was with that potential
Ah,
hostile
yes,
takeover.
yes. Yeah. Have we got
Um,
time?
have we got time? I mean, the I've done a lot of good deals, and this one was one that never got off the ground. But the stupidity that was involved on my part still leaves me wondering today. But quick background on the company.
Hmm.
Publicly traded company. The company had developed I put this in quotes, a new technology that was supposed to revolutionize this industry. The CEO of the company that had developed the technology uh, also decided to go on an acquisition spree to buy. This is in the ice industry, so
Hmm.
it's a publicly traded company. The company was a company called Package Ice. They developed an in-store machine that could make the ice and actually bag it on premise. And it's on the surface, it sounds, God, this is wonderful. You don't have to have trucks delivering. They're going to charge a lower price, all of this stuff. The strategy simply just did not work. The company ended up buying a bunch of traditional companies, and every time that they would buy one, they would put the ice factories in the big accounts, and so they're taking volume away from the existing plants. The efficiency in the plants and the distribution systems are going downhill, but they're putting more ice factories in. Long story short, company goes public at $8.50. When I started looking at it, it had dropped below 5. It got down as low as 2. And I was aggressively raising capital to, and I had a kind of a two-prong approach. One approach was to do an activist investment, get like 9.9% of the company and try to push for what the change was that was needed. I
Hmm.
didn't think that was going to fly because I didn't think that I would be able to convince enough shareholders at that point, even with the deterioration in the price. I didn't think I could convince enough of them that the strategy was wrong. And I based that on some conversations I had earlier. But what I thought I could do was to offer them a premium from where it was trading, and they'd probably settle. So the activist thing morphed into a tender offer for a majority of the shares, which would have been hostile. It would have been taken straight to the shareholders,
Yeah.
bypassing the board, bypassing the management, et cetera. And in the process of this, I was having more conversations with some of their largest shareholders, and really having, even though it's black and white, I couldn't get it across that there were flaws in that strategy. And I explained it till I was blue in the face. And I thought, okay, I got to figure out another way to do this because I need to get them to understand this and to why it makes sense to sell the company. And so I got this bright idea. I knew that the leading analyst covering this company worked for Bear Stearns, and I had some relationships with some people at Bear Stearns, so they got me a meeting with the analyst. And I thought, this person is going to be dispassionate. They're going to be able to hear an objective story about what's wrong with this thing because the story was correct, and I'll
Yeah.
show you why in a minute the story was correct. But and I thought, okay, this is going to be great. She'll get it. And she'll then start asking the right questions of the company. And that'll open it up more for this tender offer or even the possibility of going back to an activist approach. I like the tender offer better because I knew
Hmm.
with that there would be control. And so, I laid all this stuff out. I made the case, she's listened and I think she got it. Within 48 hours, the company had a poison pill in place. Dumbass me signaled too much about what might be coming down the pike. So she obviously, I mean, unless it was coincidence, and I don't think it was coincidence, she runs the company and says, "You got this corporate raider out there. He's got a track record of doing this kind of thing in the past, and he's looking very strongly at your company. Poison pill in place." And so there are ways to deal with poison pills, but it's can be exceedingly expensive. There's no
Mm.
guarantee. You can try to go over 50% in the marketplace. At that point, the complexities were just more than I wanted to mess with. And it was a situation where I had to raise outside capital to do it, and I didn't think that was conducive, so I walked away from it. But a transaction that had I not done the stupid thing with the analysts, if I'd thought, if I'd been more results focused and thought through the thing, I never would have had the meeting, and I would have just proceeded with it's the point that I got the capital raised doing the tender offer. And what's ironic about the whole thing and sad to me is that it wasn't too long after that the board of directors of that company woke up and they
Mm.
fired the CEO. And they brought in a guy that was from the milk industry that was more traditional. And everything that I, in my plan that was proposed, he did all of them. And the EBITDA margin turned around, EBITDA growth turned around the whole company. And they ended up selling for a very, very good premium to private equity several years later. And he just went back, the new guy went back to the basics, which is what I was
Yeah.
advocating. Um, I could have done that had I not been such an idiot in talking to the analysts. So
Did you manage to keep
that was a
any of
real idiot
your?
move on my
Yeah,
part.
that wasn't a smart move. Did you manage to keep any of your shares though, or did you offload them
No,
after the poison pill event?
once I'm not going to pursue it, I don't do passive. So I
Ah, well, that's a negative story. What have you got a good one you can share as a
yeah,
high to the
I've got a good
thing?
one, and it's not one that it's not the highest return, but the reason it's good is kind of twofold. At least to me, it's the best deal that I think I've been involved in. For actually, there are three reasons. One, I had pursued this company for 15 years. From I was an activist in it for a period of time, got good results, but it was with the activist situation, with additional equity offerings, I started getting diluted, and the ability to have impact kind of waned. And I tried this and I tried that, and early on in the company's life, I'd actually raised capital for them in the U.S. and
Wow.
then involved in somewhat in Canada raising capital. But very long story short, it took me 15 years to get in a position where the company could be taken over. And so I was fortunate to be able to partner with a private equity firm to buy the company. And we bought it in 2012. And the reason that the transaction in for me is my best or my favorite transaction is one being able to do it after pursuing it for 15 years. I mean, that was a lot of gratification there. Yeah,
Hmm.
I'm nothing if not persistent. So there was that. Secondarily was the amount of improvement that was made to the company. And again, as talked about earlier, none of this stuff is rocket science. This wasn't rocket science, but every aspect of that company, and we replaced the full board. We replaced not only the CEO, but the entire senior management team. And the new CEO put in with our involvement a new team, and they just did an extraordinary job in every aspect of the business, improving efficiency in all aspects of it, growing the top line properly, doing the acquisitions correctly.
Hmm.
And when we exited it, it was good. But I've had other situations that I've had more leverage in, or for whatever reason, a timing factor where returns were great, were greater. This one was good. Don't get me wrong. It was really good. It just wasn't the best return, but it was the best from an operating standpoint of improving every aspect of the company. And that's
Yeah.
that's really the thing that drives me. What drives me crazy is to see people running a company at less than its potential. There's something about that triggers the I'm not sure, it's not a predator instinct, but it's something. And so that was real gratifying. The third thing was I knew a lot of people in the company, and I knew how bad morale was, just horrible at the time that the deal was done, and had been for quite a number of years. And the problem was the current CEO had been in place for like 5 years, and the business had deteriorated. EBITDA had declined 32% under his tenure, and he wasn't a bad guy, but he didn't know how to engage the people, and some morale was bad. And
Hmm.
that was one of the things we were able to have impact on. Is by the time I act way before, but by the time we sold it, morale had improved so much, and we weeded out some of the lower performers. But those who remained, it was a high energy, exciting company. So that was also very rewarding. I like to see all those pieces take place.
Great.
And the performance, like I said, the EBITDA had declined 32% over the previous 5 years. During our 4.5 year ownership, it increased 76%. Not a huge amount when you think about it over that period of time, but you're dealing with a very mature business, virtually no organic top line growth that's that mature.
Yeah.
And it's not something that's going to take off where you're going to get huge leap bounds. So everything, it was a big, big game of inches,
Yeah. Yeah. Yeah.
but executed extremely well by the new management team.
Well, at least you learned that was after the poison pill event, was it?
Yeah, that was after the yes, yes,
Life got better and you learned from your mistakes then.
yeah, for sure.
That's amazing. Okay, well, I'm conscious of time. I think that's a good place to stop. But once again, thank you for doing this. This has been great. This is going to be such a great podcast. So
Well, I've thoroughly enjoyed it. If you have further topics that are something that I could halfway intelligently respond to, I'm happy to do another one anytime you want to do it.